Good morning. Today is Monday, August 2nd, and this is the ADM Investor Services Weekly Market Kickoff. Please note that the views and opinions expressed here today are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services or ADM. Today's guests are Steve Freed, Vice President of Grain Research at ADMIS, and Alan Bush, ADM Investor Services Senior Financial Economist. Steve, let's start with the grains this morning. Corn and soybeans have dropped and are now near key support. Why have we seen this market action, and do you believe the support will hold?
I think it's kind of a seasonal thing. I think that when we look at the eastern Midwest, weather conditions are very favorable, and there's talk of record yields, both corn and beans there. So the fact that the Dakotas, parts of Minnesota, even western Iowa, Canada is not getting rain seems not to be the front focal point. It's the fact that we could have record yields in the east. Our export new sales for new crop is also slow, so the funds have been steadily liquidating out of their long positions. I think we're near value right now. Every time the market bounces, especially in corn, end users ask me if this is a bottom. And so I think we're near support. It's just any further down, the farmer probably won't sell. Any further up, he probably will sell us a lot of corn. So I think we're in a trading range until we get through the USDA report and get through harvest.
The wheat market, Steve, it, however, has rallied over resistance. Why is that?
I think it's three reasons. Number one, they keep reducing the Canada crop because of dryness. Now they're starting to reduce the Russian crop because of dryness. So when we look at the 8 global world exporters of wheat, stocks to usage ratio are now record low. U.S. prices are still a premium to the rest of the world, but I think we're putting some kind of supply and demand premium on the market. Second place, I think that our U.S. crop is going to be smaller, which makes the carryout drop. And anytime the carryout drops in any commodity, prices are going to rally. And then secondly, technically, we've pushed through, especially Chicago and KC, some really critical technical resistance levels that's bringing in new buying.
So some weather problems in Eastern Europe. But Steve, speaking of weather, let's talk about the next 2-week weather forecast for the Midwest here in the U.S.
All year long, we've been having a lot of problems with the 2-week forecast. The American model has been wetter than the European model, and by the time we get there, shower activity, especially in the Western Corn Belt, is less than normal. And today's the same. The American model has rained next week. Some even in the northern plains and Canada, whereas the European model is not as wet. We don't have a lot of hot temperatures, but I think August is going to see less than normal rainfall, especially west of Mississippi, which raises doubt about the U.S. corn yield at 179 and the bean yield at 50.8. So I think at some point in time, we're going to have to put some kind of supply premium back in the marketplace.
And let's take a look at some of the financials, starting with the stock indexes this morning. Futures have advanced for 6 consecutive months now. Will August be another month of gains despite the weak seasonal tendency for August?
Yes, I think it will. Of course, we did have a very strong series of gains. And keep in mind that earnings have been very good as of late. In fact, by some measures, record earnings increases. Not to mention we have the very low interest rate environment. So yes, I would not be surprised to see August higher on the month, and that would be the 7th consecutive month of gains for the indices.
And in the first quarter of this year, most major central banks were talking about withdrawing accommodation in 2021. Is this still the case, or has that sentiment shifted?
I believe it has changed. And one thing that should be noted, the yield curve has actually started to flatten, and in fact that started in May. So that indicated that maybe the rate of growth in the global economy possibly is slowing. And if that is the case, which I think it is, that means that central banks are now more likely to refrain from withdrawing accommodation. Of course, we did have some central banks, including the Bank of Canada, cutting back on their bond purchases. We have the Reserve Bank of Australia holding our policy meeting Tomorrow, they may cut back on some of their talk to withdraw some of the accommodations. So absolutely, I think there's a strong case to be made that central banks will be very slow now to withdraw some of their easier credit policies.
One more question, Alan, and it has to do with the gold market. What is the most important influence on the gold market in the short term? Is it the actual inflation numbers or central bank policies?
Well, first of all, in the long term, it's the inflation that has dominated the gold market. It's, that's very logical, but you have to keep in mind that anytime there is more inflation, it means central banks will tighten credit. And of course, tightening credit policies are bearish. So in the short run, traders are looking at how central banks are likely to respond to the news. So it's the accommodative policies that are dominating over the inflation news. And you can see it on a daily basis. Anytime any report comes out that would suggest central banks will be slow to raise rates and keep their accommodation, that actually positively affects the gold market. So the gold market, I think, in the current environment, with central banks likely to remain accommodative, is likely to work higher from these levels.
Thanks, guys. Remember, the views and opinions expressed today on this video are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services or ADM. If you'd like more information about our brokerage services, would like to speak to one of our experts about managing your risks, or would like to open a trading account, please visit www.admis.com.